Good afternoon, everyone. Thank you very much for joining our first half earnings update. Today, I have here with me our CEO, MD CEO, Mr. Damit Palewata, our Chief Operating Officer, Mr. Sanjay Vijaywana, our Chief Growth Officer, Mr. Bimal Pereira, our Chief Financial Officer, Ms. Anuradhi Dalage, and I'm Priyanka. So let us, as always, start with our presentation, which would be followed by a Q&A session. Over to you, Damit.
Thank you, Priyanka. Good afternoon. Welcome to HNB Investor Update first half 2025. So I would like to first start with the financial performance. And on the financial performance, if you look at how the income is earned through the first half, we have seen with the WPLR coming down continuously, our interest income got impacted. However, we managed to work with the interest expense, which is fairly favorably managed, resulting in a positive NII compared to the same time period last year, meaning the first half 2024. Compared with that first half 2025, we have a slightly above 3% uplift on the NII. So if you look at how the PLR and the NIM, net interest margins, moved, with PLR coming down significantly, whilst the loan books have grown, that was grown at a relatively a lesser margin, even though the economy expanded, exchange rates remains a little stable. The NIMs continue to contract, and there was a stress on the NIMs we have seen over the first half. Loan book has recorded a very decent growth. We have grown 117 billion during January to June period, which is one of the best first half that we have recorded. At the same time, deposits grew almost 150 billion rupees, of which 78 billion came through by way of CASA deposits, which also has a positive impact on our NIM. Having said that, those CASA is very vulnerable, can move around fairly frequently. In terms of non-fund based income, moving on, our focus in a backdrop of contraction of the net interest margins, we have been focusing very sharply on the non-fund based income, especially on the digital front, cards front, and the trade finance front. Despite the fierce competition, we have seen our net fee and commission income has changed positively over 20%, which is supported by exchange gains, which are reflected in other gains, with the little movement in the exchange rate. From a group perspective, we have seen insurance premium have grown once again over 20%, recording good total operating income growth over 16% for the first half. If you look at from where these income predominantly come from, if you look at cards, trade finance, and digital services that we offer, 90% of income comes from those three sources. So that significantly demonstrates the commitment towards the digital deliveries and progress on the trade finance activities that we have been committing ourselves, and the expansion of the cards portfolio. If you move on to the asset quality, whilst growing the loan book and continue to, can you move the slide, please? Continue to look at the incremental revenue. Asset quality remained very stable. We have recorded the best ever net stage 3 ratio of 1.59, with a healthy stage 3 coverage ratio of almost 75%. We have seen the impairment recorded the negative number, meaning that we have recovered impairments in excess of 5 billion rupees for the half year. And we foresee that the trend will continue in terms of impairment recoveries, because we see the economy is bouncing back. some of the provisions that we have made, especially in the SME segment and the segments impacted by the financial crisis are now being recovering and bouncing back, with the construction industry showing some kind of signs of recovery and bouncing back as work as usual. So then we believe impairment reversals can continue in the second half as well. In terms of asset quality, which is supported by not only by the loan book growth, but also by the net reduction, absolute reduction of stage 3 portfolio as a result of fierce follow-up on the net stage 3 portfolio. This comes on the backdrop of the restrictions that were there on the Parate activities. Despite that, we have been managed to negotiate a lot of stage 3 facilities towards a proper settlement and a closure that results in absolute numbers reducing our net stage 3 portfolio. So then meaning this 1.59 is a very strong, healthy number we believe we can sustain into the next half as well. Moving on to the operational expenses, obviously the personnel expenses have increased compared to the first half, mainly because of we have the revision of collective agreement in second quarter of last year, meaning that first half 2024 number is having only 1 quarter of incremental personnel salaries that are resulting from the collective agreement, whereas the first half 2025 has both quarters in that incremental expenses. So that has recorded 20% growth. Anyway, given the good performance, we have bank has given a decent adjustments to salaries resulting in this incremental expense. So insurance costs have increased whilst the other expenses are managed within 15%. Our overall expenses, which a lot of them are related to incremental business activities rather than fixed cost related expenses, have contained below 20% for the first half of 2025. Moving on to the taxation and profitability, we have seen the absolute terms tax number has increased due to the incremental profits, comparative profits that we have made. However, the percentage of tax that we ultimately pay has come down as a result of the treatment of the impairment versus the last year, resulting from the ISP related impairments. So we believe this is maybe a more reflective tax rate that we will see into the second half as well, with the bank recording 21.2 billion PAT, 38% increase year on year relative to the same period, and group recording 23.2 comparative to the same period, which is 42.5%. We believe this reflects what the formidable foundation that we have set to what to expect in 2025 second half, and with the market further expanding and business opportunities are coming up frequently than otherwise, our anticipation is that this trend will continue. In terms of soundness, liquidity ratio stand, both liquidity coverage ratio in all currencies and LKR stands well above the required 100%. We are almost in LKR terms, we are 300% plus. In all currency, once again 271%. A net stable funding ratio at 156% compared to the required level of 100%. So meaning that we are adequately we are running adequate liquidity and very comfortable with the expansions that are taking place. In terms of capital, we are well capitalized above the required minimums of 9.5 and 13.5. Our actual ratios stands at 18.5, almost 18.42, and 22.46 compared to 13.5. So this allows the bank to take whatever the necessary steps, if at all, if you are looking at any expansionary initiatives with adequate capital. I think it's sets the stage that we need to deploy this capital in a more return generation manner, given the continuous accumulation of capital that we have seen over the past few quarters. If you look at the dew point analysis for the group, ROEs continue to uplift from maybe close to 16% up to about 16.7% end of first half. Return on assets increased. This is mainly as a result of our fee income getting increased compared to the NII, that is a net interest income. So leverage multiplier reduced, which is showing that we have opportunity to further grow with the existing capital, which we would like to deploy in a more return generating manner. So NII is the challenge we are seeing at the moment, which is a little over 5%, now dropped to 4.5%, maybe a little over 4.5%, which we continuously concentrate how do we manage this, and we are confident with the loan book growth that has come over the first 6 months, which will start generating NII during the second half. This NII can be addressed to a great extent, and with the new loans that are being booked with PLR now this week, it is 8.09. Maybe it will tend to move a little upwards over the next maybe 3 to 4 months. So we believe that NII adjustment upwards is possible if we carefully manage the disbursements and the segments to which we are dispersing loans. So other income increased from 1.8 to almost 2.4%, which is about 30% increase, which we see with the exchange rate movements. In case exchange rate further, that is LKR, continue to maybe slightly deteriorate, and we will see that income moving in the positive direction. Impairment continue to stay as a recovery, and we believe that will be the trend to the second half as well. So we are focusing especially on the operating cost, which have seen from 3.33% increase to 3.46%. So there are so many initiatives underway. How do we manage the operating expenses? But we will see some of those expenses that we incur, though actually are investments into the future in terms of grooming, training people, investments in technology, bringing in new systems, bringing in new consultancies. All these sets the stage probably for the next half of the decade that we are in, that is 26 to 2030. We will see something exciting. So those investments will bring to HNB in this second half of this decade. If I may put it in front of you, some of the highlights that we had during the second quarter. Key digital launch was we have launched the cashback loan facilities on our digital app, which have seen in 15 days, 15 to 17 days, 4 billion loans being booked. It's a fantastic use case where we have made convenient access to their own cash and access to loans via digital means. At the same time, we launched our online trade platform coupled with the transaction banking platform we launched last year. So this will bring different level of convenience to corporates. We are in the process of rolling it out, giving proper training and integrating with their system, so then they can manage their payment, collections, receivables, and also now trade transaction through online means. In August, maybe just after the quarter end, we have launched the City of Dreams, our 255th branch outlet. It's a fully fledged branch. The difference is that operate 24/7 right round the clock, 365 days a year. So that's the first of its kind of branch that we have launched with 24/7 operations. I think it'll bring a different level of convenience to a niche segment of customers, especially customers who do transactions with foreign currencies and do a high level of branded shopping in the complex. If I just touch upon some of the key recognitions that we have got, I think one being the best retail bank in Sri Lanka for the 15th occasion by the Asian Bank. We value it a lot. and Best Bank for Large Corporate by Euromoney. We recognize that's a very well deserved recognition that we have received given the growth and the resilience the corporate banking portfolio has demonstrated even during COVID and through the crisis and post-crisis recovery. I think they have done a fantastic job in supporting the corporate segment in the country. And trade finance side, we have awarded as a market leader in trade finance services, which reflects our commitment and dedication to facilitate trade transactions. So whilst there are many more that we have won, maybe these are the few feathers on the hat that we believe we received over the period. So that's the summary in short. Maybe now, if you have any questions, we can open the floor to take any questions.
Thanks, Amit. So you may either use your microphone or use the chat option. There's one question on the chat option, so I'll start with that. Could you provide more insights into credit growth from March to June 2025, specifically relating to term loans in both local and foreign currency? Which business segments have been the primary recipients of these loans?
Maybe I can take a little bit of an insight into it. First quarter has been a very tight quarter for HNB. Second quarter, we have grown maybe close to about 100 billion rupees. The growth came from maybe 3-4 segments. One is the corporate led the growth, both local lending as well as the offshore lending. At the same time, lease portfolio took off the ground with the restrictions on the vehicle imports being lifted. We have seen a fair amount of lease facilities are getting dispersed. In fact, the record numbers we have seen on the lease portfolio. At the same time, housing loans, especially with the urban apartments moving positively, and with with the pace, so we have seen housing loans have recorded good growth as well. So those are the segments from where we have seen, apart from not necessarily the term pawning, have seen somewhat resilient growth, much better than the first quarter. At the same time, we have seen personal loans which are very slow to pick up. There is an interest being created, both segments, cards and loans. Maybe a slow growth that we have seen in the first quarter accelerated a little, but there is a lot of potential for those segments to grow in the third and fourth quarter as we see.
If I may take another question on the chat. Related to loan growth, there's a question on leasing. With leasing, which vehicle segments contribute mostly to new business for the bank? And asking about the finance company as well.
You want to take?
Yeah, so I think we've seen a lot of movement on the EV side, especially from the BYD. Sort of the numbers were sort of led a lot of the growth in that area, but there are also lots of still registered vehicles also being moved around. I think the rate is key, so that has supported the growth. So essentially, even on the SME side, we see so all the portfolios, the different segments have relatively good growth, but predominantly more on the BYD and the EV sector is we've seen growth.
And there's another question where it's asking about bank's expansion plans in relation to branch network for both bank and the finance company.
So in terms of bank, I think our expansion is predominantly focused on digital means. So the last branch that we opened in City of Dreams is a specialized unit which operates 24 hours. So we believe the reach through digital means is not only viable, but also is more effective, reaching to a larger segments of clients. But at the same time, we are not negative in looking at locations where we can reach larger segment of community. If we provide the services that we do, we are more than happy to look at it in time to come.
There's a question on deposit growth, and it says the reason behind the sluggish growth in deposit growth, whereas I think we've recorded a 9% growth. Anything that you want to add, Damit?
Yeah, so deposits, I think we had a fantastic growth. I don't, by any means, categorize this as a sluggish growth because 150 billion deposit growth for half year. If you look at how much we have done first half last year, this is almost a full year's growth that we have recorded in 6 months. So we believe that despite the low rates, the deposits coming into the banking sector demonstrate to a great extent the confidence that the deposit holders have in the system. Plus, they still believe that, what they get out of that deposits are worthwhile to keep the deposits in the banking system. But we see even after the second quarter, maybe now today is 15th of August, so we still, 18th of August, we still see a lot of deposits are coming into the system, and maybe last 6 weeks we have seen once again similar trend in deposits. So therefore we believe deposits will continue to be in the system, and we will record significant gains in the deposit growth side this year.
There is another question again on HNB Finance in terms of the growth in HNB Finance loan book, saying continuous lending growth puts pressure on HNB Finance capital ratios. Are there any upcoming capital raising plans to strengthen the capital base? We
just closed the rights issue, and we believe that profit accumulation itself will give sufficient buffer for envisage growth maybe for the next year or so. So we can contemplate based on the growth and the expansion plan that is being currently contemplated, how do we need to infuse capital for HNB Finance.
And this question on the outlook for SMEs going forward, credit growth for SMEs going forward.
So we see quite a bit of growth in SME. If you look at our SME portfolio, which is about, I would say it is close to 340 billion rupees is our total SME portfolio, which is in terms of both microfinance, SMEs, and maybe the top end of HNBs we categorize as emerging corporates, which are indeed large SMEs. So we see quite a bit of demand for working capital, plus their expansions. So we believe the trend that we see in seeking for new facilities and expansion working capital, the trend will accelerate in the third and fourth quarters, and we will see the SME recording a better growth. And with the high acceleration in the second half of the year, SME books will contribute much better to the overall composition of the loan book by year end.
I think Damit answered part of the question. Next question also, which says which segments are expected to drive medium to long-term growth?
Obviously, the SME segment, we anticipate that to come because now we see is there is a tendency new technology being adapted, especially in the segments like agri, the processing, manufacturing, export related. There is a significant drive to facilitate exports. And we see quite a bit, if you move out of Colombo, some of those factories are being set up. We would like to, witness that. And also at the same time, some of the large corporates have started expanding. We see manufacturing plants are being set up at the moment, maybe rubber sector, maybe pharmaceutical sector, and maybe multiple other sectors. We are seeing that expansionary plans are taking place. So that means it's not only revenue, not only turnover, but also the employment being created, which is a good sign in terms of money circulation that we will see. So we think, therefore, SME sector will be a good medium to a long-term contributor for the loan growth, whilst the large corporates similarly will add capacity and employment to the system by making the expansions.
The next question is on average lending rates. How does your lending rates vary across main segments, leasing, corporate lending, housing loans? Could you also share what proportion of the total loan book is attributable to corporate lending?
So almost 50% is corporate lending, maybe a little over 50%. That is because corporate book grew faster than others during the period of challenge of the economy, and it is more it has more appetite than other segments because of the risk levels. So slowly, when the risk is tapered off with the economies recovering, more interest being generated towards SME, which put together with SME and microfinance, together with emerging corporate, it's close to about 30% of loan book there. So we will see in terms of pricing, our pricing mainly relates to the risk level that we undertake, meaning that maybe less riskier, better rated corporates through our internal risk rating system will attract a better pricing with maybe thinner margins. So that's inherited actually. So SMEs and maybe large SMEs and the EC, the maybe slightly fat margin than the large corporates that we work with to compensate the risk that we undertake, and the facilitation that we do in different segments of the economy. Housing loans, I think better rates than most of the years that prevailed, because we are promoting housing loans aggressively. So then it is maintained maybe at a, even though lower margin, may be offered at a different tenures in terms of number of years of repayment. It can go up to maybe even 15, 20 years with a decent margin to avail for a house. At the same time, personal loans, we are not seeing that much of a growth, which probably at a much better margin than any one of those, because it's clean, unsecured lending to individuals. So that hopefully in the third and fourth quarters that will pick up, that will bring some level of sanity to the margins that we are looking at those 2 quarters.
I think with that answer, Damit answered the question on margins and the expectation. So I may not take that question. So there's a question on foreign loan disbursements that have picked up for the quarter, asking for the strategy going forward and the margins on these disbursements.
So I think these are the loans which are used fairly decent margin, I think much higher than if at all, if we lend in the local market. The situation is because the banking system has enough dollar liquidity, and it doesn't find suitable opportunities or instruments to deploy those dollars in the local market. So therefore, there are very conservative risk opportunities available in maybe regional markets and maybe little beyond region to deploy those dollar funds, maybe short to medium term. We have not committed any long-term dollars offshore. It's maybe short. At worst, it is medium. So with much higher margins than it is lent in the local market. So therefore, I think those deployment of dollars bring compensatory margins for the tight stress that we have on the rupee-related NIMs, and also it gives an opportunity for us to deploy dollars that we have accumulated through incremental exports and worker remittances, and also tourism income that we receive to our accounts by way of foreign currency. So those are being properly deployed now with the portfolio.
There's a question on the bank's medium-term expectation for interest rates.
So we would expect maybe Bimal and Anurag also can chip in. So our expectation is interest rates will maybe have a tendency to slightly move up, but that will not mean that it will deteriorate to double figures, given the demand for the loan book and the economic activity that we have seen, which are slowly moving to the consumer segment as well now, because creating the space on the disposable income of individuals. So maybe there is a chance, unless there is a rate cut in the next monetary policy review, we would see maybe at least few basis points the rates will move upwards in the next quarter to come.
There's a question on worker remittances into Sri Lanka. What share is currently routed through HNB, and do you expect this share to improve?
So at the moment, we have maybe about close to 12 to 13% share on the remittances market with HNB. We have seen remittances are coming through multiple channels, including digital means, fintechs outside the banking and banking. Exchange rate is a critical factor in routing worker remittances. So we are very conscious in managing what is it that we need to maintain in routing worker remittances. So we have the ability and opportunity by managing that, even to move maybe a couple of percentages, even 3-4% up on the market share. But we are conscious that we should not do that at the expense of recording an unviable product. So therefore, we are happy where we are maintained, but we will continue to facilitate that as a financial institutions to come worker remittances through the banking system wherever possible, but whilst maintaining more robust practices in terms of managing our exchange codes.
As a question on provisions, given that provision cover remains high, do you expect further impairment reversals in the next 2 quarters?
I think I was clear even in my presentations. We will expect trend to continue. We have 75% provision coverage with 1.5% net stage 3 ratio. So and some of those industries and specific customers bouncing back quite healthily. So our anticipation is next 2 quarters, it is more likely recovery than impact to the P&L by way of impairment.
With greater rate stability, would banks be willing to increase the fixed rate period on housing loans?
You want to comment on that?
So actually, we've been having quite a range of fixed rates for housing going up to 10. I think from seeing the rest of the market competition, I think that's a fairly decent tenor that we operate. And in the recent past, we have actually seen a movement towards longer tenor requirements from our customers. And we priced also fairly, fairly well for even long-term customers to take that option. So we are not looking at going beyond the 10-year for fixed, but we obviously have a longer tenor. If you want to do a fixed and floating option, clearly we can go up to even 20-25 years. But in terms of the fixed rate, 10 is what we are comfortable with at the moment.
Yeah, I think Bimani has given a clarification to her previous question on deposits, where she mentioned sluggish growth in deposits. So what she's saying is this is in comparison to the loan growth. Bimani, so here our ADR previously was, or ADR is basically around 70%. So that's one reason I would say where, advances have grown by about 12%, deposits have grown by about 9%. But that won't be called as a sluggish growth given the numbers that we have seen. Damit, anything that you would want to add there?
So that's the if you look at ADR, we are at the moment under 70. So the challenge that we have is if we be further aggressive on deposits, which first half seen maybe almost level of deposits we have raised over the last full year being brought into the bank as a expansion on the deposit portfolio. If we be further aggressive, so with the economy expanding, we believe it will take maybe a lag effect to deploy them, and maybe it will dilute returns if at all, if you look at in that sense. So then we think it's way more strategic to keep the deposit growth and the loan growth where we have adapted at the moment, which will, whilst ensuring it supports the deposit growth and the aggressive loan growth, and it also balances out the returns that we would like to make out of managing the assets and liabilities. So if the things have significantly changing over the next quarter, maybe we can have a relook at it at the end of the third quarter. What strategic differences that we need to adapt, maybe from the last quarter onwards, if at all that is required.
Related to deposit growth, there's another question. What factors contributed to the increase in local savings accounts deposits? Was this merely a one-off quarter-end phenomenon, or is there a broader trend at play? Could you please shed some light on this?
Yeah, so I think as a strategy, we've been focusing quite heavily on CASA. And even if you look at our digital investments, both on the retail side and on the corporate side, is about supporting this CASA drive. So the transaction banking system, supporting all the corporates to route their transactions and therefore their CASA, and the individual digital app supporting again all payments. Support us to mobilize a lot on the CASA side, and also our merchant acquiring business. We have a market share of over 40% on the card side, so that again supports the businesses to operate their key operating mandates through us. So that's been a very focused drive. Even if you see our CASA ratio, it's been increasing over the quarters, and our aim is to get that up to 40%, which we feel is comfortable for us to operate. So it's not a one-off. If you look at it over the last few years, CASA has been a focus growth for us. And in line with our investments, and now even with trade being added on to our transaction banking, this will support that strategy, and that's a long-term play that we have in mind.
So there are two questions related to exchange rates or FX. One is, with CBSL focused on building reserves, are you seeing any pressure on FX liquidity in the market, and how is that impacting HNB's operations? The second is on our expectation for medium-term exchange rate.
So obviously, the first one is no. We don't see any pressure on the exchange or the way that we operate with foreign exchange as a result of central bank is building buffers. I think there is enough liquidity in the market, enough inflows that we see in terms of exporters and worker remittances, adding that to the tourism income. I think the season is coming up. If at all, that will ease out if there's anything, which we don't see at the moment. What is the second question, Priyanka?
Medium-term expectation on exchange rate.
Yeah. So exchange rate, I think it's a very tricky question. So what we would see, if at all, if we continue the trend, we would see the dollar rupee, maybe dollar at 303 to 305 range, as it is the activities that are seen now compared to what we had maybe 6 to 9 months ago. Having said that, any disbursements on the funding side that we receive that can negate any deterioration in the rupee with adequate infusion into the market. So that has to be watched out for. In all, what we see, the dollar is maybe it's marginal depreciation that we would see in rupee, not as drastic depreciation that we have seen earlier. So meaning that it will more or less remain stable compared to the movements that we have seen.
There's a question on the geographical exposure of HNB's offshore loans. What are the locations is the question.
So we have, I think it's spread in multiple areas. We have exposures into regulated segments, that is RBI regulated segments in India. We also have exposure in Africa, so which is once again well regulated. Then also we have some of the exposures in the Middle East as well as Far East. So those are the areas, geographies that we have exposures.
Next question is, can you provide the average duration of the bank's deposit and loan portfolios? Also, what's the usual tenor of the leases obtained recently?
So average tenor of the loans and deposits, I think we may need to get back unless we have an average figure for the entire loan book. But in terms of leases, maybe I would say usually the leases go 4 to 5 years. Very rarely goes up to 7 years. So I would say the average lease is around 4 years. Anything, Priyanka, you want to tell on the average portfolio duration?
So on the deposit side, let's say about 35 is on CASA. FD mainly it's towards 1 year.
Right.
And then if you look at loan book, probably about 60 to 65% is on variable terms. And then let's say you have your housing loans, the leases, housing loans probably look at maybe 10 years on average, I would say. Leases around 5 years. So, and the term loans probably would be around, I guess, 4 or 5 years.
Yes, not with the corporate, 2 or 3 years maybe on the term.
So there's a question on HNB Assurance. Could you share a brief outlook on HNB Assurance earnings? Do you expect pressure from lower yields? And to what extent can growth in GWP and cost management offset this?
HNB Assurance, we think there is a significant potential that for them to grow on the GWP, which associated with related costs. So then, given the competition, we believe the incremental growth and the pace that they are in, we should be able to manage the cost escalation within. So that is our anticipation with the programs and the strategic initiatives they run in the first half, which may go into into second half, easing out some of the fixed cost or cost structures that they have implemented. So that will ease out the related costs in the second half. If you see this trend continuing in this next quarter, I think we may look at some, meaningful ways to contain that in the last quarter itself.
There's another question related to the group. Why is HNB Investment Bank going on such a hiring spree after the complete takeover? In terms of corporate hierarchy, how is it going to fit into the group and its future?
So obviously the going to recruit people because we acquired it with a purpose. We see a significant potential for investment banking, capital market transaction in the country. So it is essential that we have the right resource. It is essential that we recruit with the purpose that we have acquired the company for. So therefore, you will continue to see we are expanding. You will continue to see that we are hiring right people, and you will continue to see we are coming to the market with different propositions and instruments for the investment community to piggyback on. So what is the second question?
It's basically what is
the hierarchy? So investment banking actually stands at a priority segment for our hierarchy because we see both local and overseas expansion potential in this particular segment. with the niche that we would like to create in that segment and the returns that it can offer at a decently acceptable risk levels. So I think investment bank will stands at a higher priority than any subsidiary, followed by the insurance and the finance company.
Next question is, what is the current exposure on government securities? What is the target loan to deposit ratio in the medium term?
Current exposure on the government securities. So we have about 890 to 900 billion in government securities of the total assets, which is about 44%. 44% of the total assets are on government securities. So that means still there are enough money if you want to grow and expand the loan book coming out of the government securities and investing and directing those into the segments that the loans necessarily require for growth. What is the other question, Priyanka?
Target loan.
What is the target loan to deposit ratio?
So that of course at the moment it is at 68%. So we think with the trend that we have seen on the deposit side, which is somewhat not in alignment with a lot of thinking that it will with the lower interest rates where it will move. So we think this advances deposit ratios were maybe above 80-90% before the COVID hit and before the crisis. So we believe at least in the medium term, it will go up to maybe 75% to 80% with loan growth continuing at the same level.
Earlier on, given the strong capital accumulation and the absence of M&A in the pipeline, should we expect upside to the dividend policy?
So I think we have been paying a fairly decent dividend throughout, and last year being the highest, we paid the cash dividend of 15 rupees a share. I think that's a fairly uptick and uplift in what we have been offering in terms of dividends. We would like to continue a similar trend in years to come as well. There is nothing to say that M&A is not in the pipeline. So we are carefully scanning the opportunities with such a capital buffer in place and liquidity and such a great asset quality recorded being one of the best among the industry. It is right time for us to look for right opportunity, and we are not hesitant to look at that opportunities if at all if they come through.
Are there any further questions?
Sorry, could you do indicative lending rates by the crib score so that we get a sense of, based on your crib score, how much you could borrow at?
So is it for the retail segment, or are you looking at
Yes,
all
for the retail segment, or even for smaller loans, wouldn't it be better if people had an indication of how much they could borrow at, given their crib score? Because you can get your own crib score.
Yeah. So unlike the corporates and the SMEs, that the risk-based pricing works quite effectively on the retail segment. It's a little difficult because the range that we want to play in is not as vast of in terms of the spread that we can differentiate. And also what we have seen is generally if you do display some sort of preferential rates, then there is quite a demand for that from the retail customers to get those rates, even though they don't fall into that category. So the pressure on the network operating a 250 branch operation makes it a little difficult to do so, and also because nobody else has also taken that particular path. But in the future, as the crib score becomes a little more popular amongst the general public, I think it's option we can look at. But certainly now, at least we are using it very aggressively for lending purposes. I mean, we are able to give faster turnaround and give facilities to say give out credit cards, personal loans, etc. in terms of a turnaround time based on the CRIB score. So that is being used right now, but in the future, depending on the behavior of the retail segment, that is something that we can look at.
Are there any further questions? So if there are no other questions, thank you so much for joining our first half earnings call. We look forward to talking to you once our third quarter results are published. Thank you very much.
Thank you. Thank you very much.